All right. What is going on, Rich Gang? Hope you guys are having a fantastic week. Hopefully you guys are getting ready for the holidays. It's going to be a good time. Today we're going to talk a little bit about why you shouldn't invest in Palantir Technologies. And I think a lot of times when I talk about this company, it's a little bit under 4% of my portfolio, but I have huge conviction in the company. But I recognize that it's not a company that everyone should be investing in, right? It's got some speculative nature to it. It's not profitable, and a bunch of other things we're going to go through today in this conversation and in this video, specifically talking about why somebody like yourself might not want to invest in it, and that's perfectly okay. Where I hope that some folks recognize, though, is that some of these things are temporary, and then in the long term, I anticipate that Palantir will be a phenomenal investment for some. However, there is speculative nature to it. It's going to be volatile. It's going to be something that you need to recognize whether or not it fits appropriately into your portfolio for your investing needs. You might be somebody that's looking for income. You might be looking for a return in the next year. You might be looking for something that's very stable. You might be looking for something that is not as volatile as what we're going to be looking at today, and that is not Palantir, right? We're talking about something that is going to be in the trenches, and it is in the trenches right now, and might continue to be in the trenches for the next year to 2 years, 3 years, until things truly get profitable for the organization. And who knows, stocks are, organisms just like you and I, and who knows if it actually gets there, right? I'm pretty confident, 90%, 95% confident that it will get there. But somebody like yourself might be looking for 100% confidence, and you might be looking for something that's profitable today, and that's okay. And here I am to show you some of the reasons why you should not be investing in something like Palantir. So let's just hop right into it a little bit. I have a bunch of different things kind of coming up here on the screen, and first and foremost, a lot of what people bring in to the room is stock-based compensation. You can see specifically the revenue growth quarter over quarter in this blue line coming in here, whereas in the gray, you can see the stock-based compensation spiking when they had the direct listing and slowly coming down as a percentage of revenue accordingly. So now it's a little bit less than 50%. It's probably in the order of 25 to 30% of the quarterly revenue now being eaten up by stock-based compensation. So let's just take a little bit of this article here, which I'll leave in the description for you guys. The problem with Palantir is that it's went overboard in the form of pay. To put things in perspective, its stock-based compensation expenses over the last 11 quarters amounts to $2.42 billion. This figure may not seem much in isolation, but it accounts for 64% of the company's total revenue during the period. The question that everyone now is asking, has Palantir top brass performed really that well in order to deserve that kind of pay? It's a valid question. I want to point to the readers that have things considerably improved in Palantir's June quarter. Stock-based compensation is only 30.8% of total revenue and has dropped to $146 million. The real impact of lofty stock-based compensation expenses show up in Palantir's profitability, which obviously shows up on a GAAP basis for sure. The company reported an operating margin of negative 8.8 last quarter, which would have actually been a profit margin of 22% without the impact of stock-based compensation. So this goes into the fact that you have a $148 million drag on the last quarter's earnings because you're giving out stock-based compensation. If you remove that, you're actually profitable from a GAAP perspective. But because you're giving out that stock-based compensation, you have to include that in your net earnings, and thus you're pulling a drag on the organization as a whole. Another cool thing, which may or may not be something that you might be looking for in organizations, is they're growing into different industries around the world. This says 36 industries. This was their Investor Day presentation back of September 2020. I've since seen upwards of high 40s, low 50s numbers, if I remember correctly. And it goes to show you how quickly they're growing in the commercial sector. This dates all the way back to 2008 timeframe, where they were mostly focusing on, prior to that, the government sector. You can see how many different industries they are now in this blue getting into for the commercial sector. So now 36 different industries, and that's with the two operating systems at the time, which were Foundry and Apollo, and we know that they're continuing to work on different operating systems going forward. So that might be something that you might recognize as, hey, they're trying to get into different industries. And I've spoken about this many a times. To me, they're focusing on getting aerial coverage, right, with a multitude of different industries until they get that, say, full coverage of however many industries they want to get into, whether it's 50, 60. That's when they'll start to go into working on other clients, right? You now see that they're having a pretty good dominance in the oil sector, working with Apache, BP, many other companies like that. And you're starting to see that they might be overlapping in the logistics sector as well. So it just goes to show you that they're trying to build these custom applications on top of their operating systems prior to really expanding. But that might be something that you're not interested in, right? I mean, you might be looking for something that has already been established. It's more mature of a business, and I get that, right? It's all about where your investing needs are. And this is another thing that might concern a lot of people. It requires a lot of upfront capital, or at least operating expenditures from Palantir's standpoint in the acquire and expand phase, prior to when they actually are able to get their nuts and bolts and actually like return on their investment in the scale phase. That might upset people, right? Some people might be used to providing a service, getting paid day one, right? That's not really how Palantir operates. Palantir will embed themselves in your organization, and then eventually, after time, once you actually start utilizing the product, it's up and running, and you're, kind of hands off a little bit. Of course, there's some guide rails there for you if you need from the front development or full development engineers, forward development engineers. But if you just take into account the initial investment that Palantir is kind of putting into the businesses, you're not going to get money day one. And so that might upset some people when you're looking at the massive quarter over quarter growth in customers, recognizing, do I have a customer growth chart here, that you've since grown, what is that? I'm not good with math. 25 new clients in the commercial sector since last quarter. And here you are now having to pay for that operating expenditure, which is going to hit on operating margin and what have you. But in the long term, you might think, 2 or 3 years down the road, that's when it might start bearing fruit. That might not be something you're interested in. You might be looking at something that's bearing fruit in 6 months, a year from now, right? And so that's perfectly acceptable. It just might be another reason why you might not necessarily be interested. This is just rather, I guess, unconventional and not usual for companies. Generally speaking, you get a service, you get paid immediately. Whereas Palantir is more so looking for, is the relationship right? Are we going to be able to do, and how much are we able to kind of put into the business? But what I will say is now that you have some of these different, and this kind of goes back to this last slide, of the 36 industries now out closer to 50 industries around the world. Now that you have that dominance within each individual industry, or establishing a dominance, I should rather say, you can go to a different oil and gas company and say, hey, here's where we started with say, an Apache, and this is where we've gotten to now, or this is where we've gotten with Airbus, and now deploying it to your organization, these are the tweaks that we can make. Do you agree? How can we help? Right? And so it's a little bit quicker of an acquire and expand phase to the scale phase, because they've already built the custom applications for, say, Airbus. And if they move to a company like Lockheed or something of the like, they could say, oh, well, we want to tweak this application, we want to tweak this application, but the operating system wholly remains the same. It's just the applications that are on top of the operating system might change slightly. And so that hopefully will shrink this acquire and expand phase, but that doesn't necessarily negate the fact that there's upfront cost associated with some of these things that you guys might be needing to look out for, especially if you are somebody that's more of an income focused investor. I also want to highlight the full year 2022 numbers here. So they're reaffirming a $1.9 billion guidance with a $6 million currency impact for foreign exchange. A lot of people were hoping that this would get to $2.1 billion in the beginning of the year, and things have somewhat slowed down a little bit. A lot of customers growth were expecting in the 40s. Government growth was expecting in the 40s percent revenue, and it's just been shy of that. Some quarters were only 20%. Some quarters were even less. But you do see glimmers of hope, right? But some people might say that this is still too slow. U.S. commercial growth grew 50% year over year from Q3 2022 from Q3 2021. But this used to be triple digit, right? This used to be triple digit year over year growth. So a lot of people are giving that a huge hit, right? And your revenue only grew 22% year over year, including the commercial and government businesses. So a lot of people at this point thought would be over $500 million a quarter in run rate. And here we are still shy of that, hoping to get that first glimpse of $500 million a quarter in Q4 of 2022. U.S. revenue grew by 31%, right? A lot of people were anticipating this should be in the 40s. So I think a lot of folks are somewhat disappointed by the recent quarterly growth that is occurring at Palantir. Really hoping that we would be able to get to the $2 billion mark this year, but it looks like we're slowing down. However, there are glimpses of hope, and now this gets back to whether you believe and how short you believe the acquire, expand, and scale phases are for the company. 66% year-over-year customer growth from 337 up from 203 a year ago. 93% year-over-year total contract value closed of $1.3 billion. Q3 was really good. I anticipate Q4 is going to be even better with FoundryCon coming in. And you had 63% year-over-year deals closed. 273 deals up from 167 deals. So you're starting to see the trajectory move in the right direction in terms of acquiring more customers, but is this going to end up relating to revenue, and at what point, right? Because we've already acknowledged that it takes some time for the actual scale phase to start paying into the company. And so that could be a huge reason as to why you might not necessarily want to invest. There's the IL6 thing, which I think is really cool. One of 3 companies, I think it's other than Microsoft and Amazon, that have IL6. But some people don't really care about that. Some people might just be more focused on, hey, funny man, or hey, clown company, why don't you just continue to get more and more customers and get revenue through the door? Whereas I think Palantir is taking more of the, we're trying to build a company for the long haul over the course of 10 years, and people are looking for quarterly performance, and that gets you into a quagmire, right? Where you're looking to build something over the course of 10, 20 years, and maybe even longer, and somebody's looking for quarterly performance. And I think Jeff Bezos said it really, really well in one of his speeches that I heard, specifically talking about, here we are trying to build an organization, and all the metrics within the organization in the early 2000s were going up and to the right, but the stock price was going down and to the right? And so a lot of times also he said, we don't really care about the quarterly performance numbers because those quarters are kind of already said and done 4 or 5 years ahead of time, right? The actions that they took in order to get those numbers, they had done 4 or 5 years ahead of time, which makes a lot of sense, right? You're not building the warehouses, or you're not hiring appropriately, you're not going to get the numbers that you are in 4 to 5 years because it's all based off of all the actions and culmination of everything that you've done in the past, right? So by the time you actually get to the quarterly report, they're already 4 or 5 years down the road looking at what they're changing to be able to meet the accommodations that they're looking for the business growing the way it grows. They're not reacting to a quarterly performance number, right? And there might be some macroeconomic things that they tried to react to a little bit, but you kind of understand what I'm kind of going through and trying to explain there. So during Q3, they saw 78 deals of at least $1 million, which was pretty cool. But then when you actually start looking at the commercial revenue growth year over year, it's down to 17%. And you were on a pretty good trajectory, 37, 47, 54, 46 from Q3 of last year, respectively. And here you come in this quarter at 17% total commercial growth. And now a lot of people are saying, well, commercial is where you're supposed to be seeing the huge expansions in revenue, considering that this is a new company that's trying to enter the commercial space. and to have a total revenue generation year-over-year growth of only 17% is pretty sad. And then specifically looking at the U.S. commercial growth, still strong for Q3 of 2022, but previous quarters you saw triple-digit percentage growth. 103% last quarter, or last Q3. Q4 of 2021 you saw 132%. Q1 of 2022 saw 130%. 120% just last quarter in Q2, and here you are now at 53%. Now the good thing is you're seeing the total percentage of U.S. commercial growth going from 11%, or sorry, total U.S. commercial of overall revenue going from 11% just a year ago to almost 18%, which is good, but you're also starting to see government revenue continuing to decline as well, and the total trailing 12-month revenue per customer slightly decreasing as well, where it was expanding pretty rapidly in the previous quarters. So I think a lot of that has to do with the potential that some of these COVID contracts are starting to come off and roll off, and so you're trying to offset some of that. So I'm curious, in say 2 to 3 years down the road, if you continue to see this kind of be fully offset by the roll-offs of some of these important contracts that happened during the pandemic, and now go towards fully what we're kind of looking at. And you've seen Alex Karp meet up with the UK government, which they just announced something today, $75 million deal over 3 years. I anticipate that that's going to grow as that relationship grows. You've seen the Ukraine relationship grow. You've seen several other smaller organizations meeting up with Palantir, hopefully getting the same sort of use out of their Apollo systems and stuff of the like going forward. So I think that this might just be a blip, right? As you've seen in many organizations, right? The e-commerce trend going from 11.5% all the way up to 14% and back down to 12%, meaning the total percentage of e-commerce revenue growth, right? So things like that, that I just want to kind of allude to is maybe this is the same, right? You have some of those contracts rolling off. But there is one of few more things that some people might want to highlight specifically. Cash flow I don't want to talk about because I still think that that's positive. So, I mean, I think a lot of people look a lot at net income, but I still think the free cash flow numbers are positive, so I want to skip over that for this particular video. And I don't want to talk about adjusted gross profit because that's positive as well. But where I really want to get into is loss from operations and adjusted operating income and adjusted operating margin. So accounting for everything, stock-based compensation, what have you, in Q3, you're still looking at $62 million operating expense, not operating income. And a lot of times we kind of talked about earlier, adding back in that stock-based compensation. You can't do that on a GAAP basis. So on a GAAP basis, you're still losing money. But from a non-GAAP basis, if you wanted to add that back in, that's okay. And so that's where you kind of get to an $81 million net income. So it actually would show up as profitability. But some people really care about the GAAP numbers, right? And they should, right? I mean, you think about it, you are kind of diluting shareholders, and you are, making $140 million out of thin air to be able to pay your employees. That should be accounted for in some respects, right? I get that. But excluding that, you're at a 17%. So this is something that could be something where you look at it from both lenses, right? I look at this as the company is profitable. From a gross profit perspective, from an operating margin perspective, the company is doing well. From a net income perspective, the company is still negative. And I think that that's something that should not be scoffed at, right? That's something that I think is true and needs to be acknowledged. But what that I view this as you continue several quarters down the road. Last year, they were at $91 million burn rate in terms of net income. This year, they're at $62 million. Give it a few more quarters, and eventually that this number is going to be positive. And just like you were observing, I'm more of a free cash flow kind of guy, or just a cash flow in general kind of guy. It's going to start to be reflected in really what we're seeing here, which is you're actually getting cash flow from operations. And when you take out the capital expenditures, in this case it was $14 million for Q3 of 2022, you still are generating cash, right? So just like last year, you generated $100 million in cash, and you were able to add that right into the balance sheet. Just this last quarter alone, you're able to do about $40 million of cash and add that to the balance sheet. And for a company that has zero debt and has currently $2.4 billion worth of cash, with another, I think it's $750 million to $1 billion in unused credit facilities, you have the ability to weather any sort of storm and continue to develop and continue to operate this company in a good manner. But that is something that might not happen now that we're going into 2023, into mid-2024, early 2025. And so those are the sort of things that I want to highlight, right? I'm generally speaking an optimist, right? When I say things about Palantir, even though the glass might be half full, I speak about it as if it's 75 to 100% full, right? So I have that sort of love and conviction on the position. But I've been in this situation before where I've had conviction in positions that I didn't do, let's just be honest, as much due diligence, and I haven't used the product as much as I have for Palantir. But that is something in its own that should be obvious, is that you can't predict everything, and not every stock that you put money into is going to do well. And so that's one of those things where you have to acknowledge where Palantir is. It's pre-profitable on a GAAP basis, while the cash flow is doing well, and they are adding cash to the balance sheet on a quarterly basis. On a net income basis, they're still not profitable. And to some of you guys who might be sitting there and say, hey, I will wait, it's an intriguing company, but I really want to wait until it turns the bend and get to a point where it is profitable. And that might mean that you don't get the optimal price, right? It might be, let's just say, mid-teens by the time that happens, because people are recognizing it and the markets are generally forward-looking. But it gives you that confidence, right? And so those are things that I want you to kind of look at. The things that we talked about today: the net income, the free cash flow, the customer growth, all those things. I'm keeping an eye on specifically the customer growth and the revenue growth. And knowing that FoundryCon just happened and things of the like, I'm hoping that the revenue continues to grow. But you also have to think, when you grow revenues so quickly, it's hard to maintain a 30% compound annual growth rate, especially if your base is continuing to increase. So I fully anticipate that as we get into the 2025-2026 timeframe, they really lower that to a 20 to 25% compound annual growth rate. And so I think 2022, with everything that's going on, the fact that they were able to grow, or hopefully be able to grow 20 to 25% overall, is a glimmer of hope. And I think as things normalize, as the whole macroeconomic environment, as everyone knows, is kind of garbage right now, as we get into 2023 with a lot of these tail-end deals that are happening in Q3, Q4, I'm hoping that shows up in the second half of 2023. Coupled with the great amount of customers that were acquired in late 2021 as well. So I was going to show a graph, but I think it's time that I kind of round this video down. But I think those are good things to look at if you are truly skeptical about the organization. And I think it's okay to be skeptical. For me, like I said, it's a 4% position in my portfolio. I'm perfectly okay with losing 4% of my portfolio entirely, but I'm very well confident that we will be talking in 3 years and seeing a completely different stock price, as well as a company. And who knows what the company will bring? Who knows what the world will bring? What kind of geopolitical world we'll be living in at that point? But I think Palantir is poised for greatness, even though they have some of these things in here that show some chinks in the armor, right? And I don't think that those should be ignored, and that's why I'm making this video. So hopefully this video finds you guys well. I would really love to hear what you guys think in the comment section down below. And I'll see you guys next time. We'll see you guys on Friday. Cheers.